that everyone has had their lunch, had an enjoyable meal, and is feeling energized for our final panel discussion of this day. Joining us to moderate the last panel discussion of the day is Branson Goodwin, the Vice President of Middle East at ARC Group. Can we please give Brandon a good welcome to the stage? This panel will revolve around navigating a challenged pipe market, an alternative SPAC financing structure. And joining the panelists are Khalid Rashid, the Managing Director at Misr for Central Clearing, Registry and Depository, as well as Ashar Salim, the Fund Manager at Yaqeen Capital. And last but not least, Sumer Chopra, Director and Founding Member at Alumia, who will be joining us virtually. Please let's give them a warm welcome. And we wish you a good discussion.
Thank you very much. Welcome, everybody. Thank you for being here. My name is Brandon Goodwin, and I'm the Vice President of ARC Group Middle East, Global Leaders in IPO and SPAC Advisory. Joining me on this panel discussion today, we have Mr. Khalid Rashid, Mr. Ashir Salim, and dialing in remotely, we have Mr. Sumer Chopra. So before we begin, I'd like to thank and congratulate the AFCM on what has been a fantastic first day. A special thanks to Joe and Dr. Fadi for their hospitality, and especially thanks to the famously gracious and humble Omani community for their warm welcome to the beautiful city of Muscat. Gentlemen, let's start at the basics. Sumer Chopra, I'd like to give you the first question. What is a SPAC and how does a SPAC operate?
Thanks, Brandon. Hi, everybody. Great to be here today and to join the panel with Brandon and the other panelists. Well, a SPAC it's quite simple. It's a publicly traded corporation with a limited lifespan, generally from 15 to 24 months, formed for the sole purpose of effecting a merger. The company has no operations. It does not create any products. It does not sell any service. It's just a shell company, which is listed on an exchange to raise money from public equity investors generally to effectuate a merger with a privately or a publicly held operating business. It's an alternative to a traditional IPO in the sense a traditional IPO process is quite grueling, lengthy, and costly for a company. SPACs allow an alternative to traditional IPOs by allowing private companies to access public markets much quicker with a defined valuation and a healthy bunch of cash that generally comes in through a de-SPAC. SPACs are, well, in the past 3 years, SPACs experienced stratospheric growth, becoming a manic bubble as more and more SPACs went public via an IPO. In 2020, we saw a massive growth of over 300 SPAC IPOs, and that number was very quickly beat even in Q1 of 2021. Overall, we saw 2021 to be the highest number of SPAC IPOs ever, with over 600 SPAC IPOs in 2021. How SPACs generally work is quite simple in its nature, but quite complex in its execution. Having an empty shell company does allow you to raise capital and not incur several costs when it comes to running the company. But the management behind a SPAC is what drives value in a SPAC on top of the money. So it's quite easy in understanding the concept of a SPAC. It's very complex when it comes to their operation.
Fantastic. Thank you very much for that detailed overview. SPACs have received a lot of criticism recently. Ashar, would you be able to touch on why they became so popular?
Yeah. Am I audible? Okay. First of all, thank you, Brandon. Thank you, Arab Federation, for arranging all of this. I think it's absolutely amazing. You've pulled off an amazing achievement. Thank you so much for the introduction. SPAC, I believe, yes, we've seen a massive growth in SPAC activity over the last 2-3 years. But if we step back a little bit, the last 2 to 3 years were not only because maybe something SPAC was a new thing that people found out. No, it was basically liquidity, which was the main reason for these kind of products to flourish. This was not the only thing that flourished, by the way. The conventional equities, they did a lot. The fixed income did a lot. So basically, everything moved, and the prime driving force was momentum and liquidity. SPAC have been there since decades in the market. I mean, it's not a new product that was developed, but the only thing that this helped was probably the less regulation that it needed compared to the conventional methodologies of raising capital. That's one of the reasons. It does have its disadvantages, but again, if it starts getting regulated the way that the other IPOs are, then probably you might not have much of a difference between SPACs and the regular traditional IPOs. But again, it was an interesting time for a lot of people. As fund managers, everyone had an opportunity to participate in this momentum, and it lasted while it lasted, right? But as liquidity dried down, as we saw rates climbing up, we saw this along with other conventional asset classes taking a beating and getting hammered. So I think this is going an ongoing process. This is an ongoing process for any product. You see any balloon growth or any bubble growth in any of the product, there is a correction. We saw a correction, nothing against it. It should remain, but in a bit more regulated manner, in my opinion.
Fantastic. Khalid, you have been in the industry a long, long time, and SPACs became fashionable, but you worked on transactions before they were known as SPACs. Would you like to touch on that a small bit and some of your experience?
Yeah, absolutely. Well, thank you very much for the question, and thank AFCM for being here. I remember back in the days in maybe 2005, 2006, we were working on the first IPOs in the UAE. And one of the first deals was Ermix at that time. And the part of the regulation was to actually value the companies at the net asset value. And this was a logistics company. So it was extreme, the variation in the valuation was extremely high. At that time, we did not really hear about the SPAC in its current form. But it just started at that time to gain some speed in New York. So what we've done is we found in the law that you can actually have a private company and with 55% of its capital, and then list it, raise the other 45%, and then that company can make its own decision with its own board about the valuation of the acquisition it will make. So we went ahead with an investment bank, and we've established this, what at that time called Armix International. Okay, it was some sort of a shell company, and it raised at that time, I think, about $1 billion dirhams. And that company later on acquired Armix. Now, this company, first of all, did not have a lifespan. Okay, like SPACs have. They did not have an investment commitment period, okay? It was what we called in our lingo a one transaction fund, okay? Specifically for one transaction. And it also involved an exchange of cash because this company acquired a Braja stake at that time in Armix. So it was not a merger, it was an acquisition, okay? And it did not happen through a reverse IPO in terms of exchange of cash or swap. It happened through an exchange of cash. So at that time, this was, if you look back at it, it had a lot of the features of the SPAC, or at least it satisfies the purpose of the SPAC at that time for different reasons. And it started the whole trend for maybe 5 or 7 IPOs to follow this one. I mean, at the end of the day, I mean, I was following what my colleagues here were saying. Working in private equity in the Middle East, there were one main issue with investors, which was the lock-in in the funds. You had to be locked in for 7 to 10 years as an LP, and there was not a lot of transparency. There wasn't a big market for secondary markets for the LPs, like in the UK or the US. So the whole idea of a SPAC, okay, it satisfies the purpose of basically listing a private equity fund, more or less. Okay, so you're having, because the private equity funds are blind pools, okay, and the SPACs are blind checks, okay, they're blank checks. So basically, listing a private equity fund to acquire other entities, okay, so the LPs would have the opportunity to, one, look at their valuation all the time in terms of pricing, to exit, because in most of the private equity funds, what happened is at the life of the fund is forced to sell the company, liquidate it, okay, at whatever price to close up the fund. They only have like 1 year by year extension. So the SPAC at least offers the private equity firms, if they list a whole fund, not only for one transaction, they offer them the opportunity to take their time in their exits. I think the main reason SPACs are not gaining speeds and are facing problems right now is that right now they've been established as a one transaction fund, not as a whole blind pool fund, okay, and specifically for a demerger. So there is no exchange of cash. And then you fall into the whole redemption of the deal, okay, and the valuations and so on. And we've seen two of those very recently.
Amazing. Thank you very much, Khaled. Samar, would you have anything to add to that? Or any sort of comments?
Yeah, sure. I could comment on why SPACs are no longer, the mania is over and what really has happened, because as Ashar very clearly mentioned, it's not just SPACs as a whole, but it's the change in macroeconomic situation that happened. The liquidity buildup led to a boom in the market in not just SPACs, but a lot of asset classes. And once the situation changed, of course, most asset classes had faced a bad time, especially the public markets. But also, I believe that the reason was back then SPACs tended to be more speculative, go after speculative, high growth, cash flow negative companies, and as broader financial markets were buffeted by central bank tightening or higher inflation, recession concerns, these growth companies were disproportionately impacted. However, you know, the features that modern SPAC structures still allow has nothing to do with overall markets. You can still come up with the right deals, come up with great deals, and we're seeing that happen even today. We're still seeing great de-SPACs happening, with bringing forth great companies to public markets. Now we've thinned the herd by having only serial sponsors and people who really understand the SPAC asset class, not as a one-off financial transaction, but a long-term vision to work on the asset class of SPACs. So the world has changed since 2021, and it's really interesting. I still believe it's a great asset class and a great alternative to traditional IPOs.
I totally agree with you, Samar. Absolutely. One of the things we at our group try and tell our clients is, and it boils down to a very, very simple thing, and I think it applies to all aspects of business, is alignment. Alignment is so important between a sponsor and a target. And then, so this leads me to my next question. Ashar, why is it important for sponsors to understand the target's industry?
Brandon, that's the very good question. Now, I always say that we are not in the business of managing investments. We are in the business of managing expectations. So that's basically the role of an investment banker, a fund manager. They're basically here to manage expectations. Now, alignment is key. If you look at the very basic concept in a very layman's term, as Khaled already mentioned, it's a blank check company. So basically, you're raising funds from investors based on your competence and their trust in your skill to basically go ahead with acquisitions of a specific sector, geography, or any specific opportunity of that kind. Now, if my investors are trusting me with acquiring good logistics companies, I'm supposed to have some sort of expertise in that. Now, in order to have that, I should be very much aligned in terms of strategy, in terms of vision, in terms of what I believe growth is with my target company. Because if I do not believe, or if I do not align in terms of the vision that we both have, probably the deal might not be as successful as it would be otherwise. So it's very important that not only there's alignment of intention or goals, there's also should be an alignment of skill set. I cannot raise funds from my investors based on the trust that I can buy a healthcare company when I don't know anything about healthcare. So this is very key and very important. Obviously, you will have goods and bads at any given time, but on a median basis, if you have more deals where you have alignment of all of these, there could be less number of deals, but there would be more efficient deals, building a long-term trust in the asset class and the process as well.
Absolutely, 100%. Samar, some of the transactions that you've worked on in the past and some of the SPAC transactions, how important is alignment between the target and the sponsor in your view?
Oh, it's critical. I would even go as far as to saying that to really understand the quality of a sponsor would clearly indicate that if a sponsor knows and understands how critical it is to be aligned with targets and understand their industry, that just shows a quality of a sponsor. And this is the most important way to assess a SPAC. I think we've mentioned the phrase blind pool of capital. The reason you still go forward is by assessing the quality of the sponsor. And a sponsor really needs to be aligned with the target, not just having some experience in the industry, but really understanding the target, because a quality sponsor will always try and assist the target, not only by providing them cash and getting them listed on a market, but also helping them access newer markets to open their network to the target company and be aligned with them in their growth plans and prospects. So it's super critical.
Absolutely. What we like to try and do at ARC is, when we're advising clients, is work on a worst case scenario basis. And then we work upwards and we're aligned, we manage expectations. That's exactly what you said, Ashar. So, Mr. Khalid, what can the target do to manage market volatility between signing and closing?
I think the SPAC transaction is like any form of private equity transaction. It usually goes through the process of sourcing and then, talking to the target management, and it's a people business at the end of the day. The SPAC sponsors are usually private equity employees, okay, who understand how to work out a deal with the management of the company, that both of them are incentivized and they have the same vision, have the same strategy going forward, and can support them, because the SPAC sponsors don't manage the target, they actually govern the targets. So it's basically the same exact deal as a PE. And then you go through the process of putting together a letter of intent with, as long as you have exhausted most of the deal breakers up front, okay, and the sort of the what if scenarios, okay, and then you start going through the due diligence. Now, there are some caveats and there are some disclaimers that you put in the LOI for force majeures and what have you, or if you found any dead bodies inside the company in the due diligence process. Now, until the due diligence process ends, then you go through the closing. Usually, the closing is where you put together the final, whether you're actually buying the company out or you're actually swapping shares. It depends on what kind of agreement you have in place. Now, the process from the sourcing until the closing usually takes anywhere between 9 to 12 months. Okay, that is more or less what we see in most private equity firms. Some deals take longer, very few take shorter. The scrutiny of the due diligence is the most important factor for the SPAC industry to pick up, because what you have here is that you're approaching a target and you're actually taking it public without going through the IPO readiness program. So it will depend heavily on the due diligence of the sponsors, who should be professionals, not only in the industry, but actually on the investment process. Because that's the only thing that will protect the deal, because you can say that the market can go up or go down, you exit at the right price, but well bought is half sold. That's what we always used to say in private equity. So if you buy it right, at the right time, at the right price. Because if you could look at the couple of deals that were done in the Middle East, yes, the market conditions were not great, but the market conditions didn't go down by 90%. So yes, there was an overvaluation. The investment period of the SPAC itself played some pressure. Okay, and there is no regulator in the middle for some sort of putting regulations on the IPO process. Now in Egypt in November 2021, we've issued actually SPAC regulations. And one of the main conditions that's in the regulations is that 50% of the SPAC have to be institutions, out of which half of them have to be financial institutions, and that the sponsors need to dip in and have skin in the game with about 5% of the SPAC. So that puts the reputation of the financial institutions there. It puts their expertise on the line for the due diligence. It makes the sponsors as well accountable because they have skin in the game. And that's very common in big private equity funds as well. That is the only thing that can kind of like protect the process.
I agree. And I think challenging times and challenging markets ignite creativity. And I think communication, and again, I'm going to use this word, alignment, is a key factor. Ashar, please give us your comments on what you think the target can do to manage the volatility between signing and closing.
Okay, this is a key concern with most of the SPACs. And even if you look at the numbers, SPAC listing, and then there is a time between deal closing, and then obviously post-deal, the performance of the SPAC. There is a lot of volatility. A lot of that can be managed by proper disclosures at the proper time by the sponsor, by the target company as well when they're needed to. But most of that is again dependent on market forces. There is not much you can do when there is unaccounted for momentum in the market. Most of the recent SPACs that saw a lot of volatility were somehow linked to some of the famous celebrities, a media personality, which had a lot of Twitter, all these kind of posts, and that drove madness in those prices. That's something that you cannot control. The only way is probably proper disclosures and disclosure at the right time. So other than that, you need to do your part, and the remaining can be left upon the market forces. Now, I would just like to, quote a small example in here. Now, we at Yaqeen Capital, we have recently launched a new private equity fund. It's a traded fund, which is going to be a private equity fund, but it's going to be traded on the market. The underlying investments are private equity companies. We exit them via IPO. Now, the key concern that we face, it took us more than 1.5 years to get through the CMA in there. And the main concern that the regulator had was disclosure. Whenever you have a deal, you need to timely disclose the right information. Once you complete the deal, you have to make appropriate disclosures for the unit holders. If you organize this in a proper way, that's the best as a fund manager or asset manager that you can do. The remaining, as they say, is upon market forces. They want to drive it up, let them do it. So there's not much that you can do in their work.
Let's touch on the cash on closing element of a SPAC. I think it's an ever evolving vehicle, a SPAC, and cash and closing there's no certainty in it as of right now. So Samar, what can target companies implement to increase their chances of cash and closing?
Yeah, before I answer that question, Brandon, I think it would be interesting for the audience to understand what really has happened in terms of redemption rates in the last couple of years. So we, unlike if you read the markets, if you study SPAC statistics, you would not be shocked. I mean, back in 2019, where we still had SPACs, but it was not, the mania had not started. We still saw roughly about 70 to 75% redemption rates historically. And of course, that started to go down as we jumped into 2021. But now we're back to super high levels of redemption rates. This quarter itself, 2023 quarter one, redemption rates were above 90%. And that has a lot to do with what the sponsors do and what the targets do to protect this. Given that back when we had zero interest rates and really low interest rates, SPACs offered a great yield on the trust account, which was pretty attractive for an investor. As you understand that a SPAC shareholder always has an option to redeem their shares when it comes to voting for a business combination, where they can either choose to agree to the merger and stick with the SPAC and the merged company, or they can redeem their shares and get back their initial investment plus a nice yield. And because primarily hedge funds jumped into SPACs fairly quickly, they've always been there. They use these yields. For them, it's a great return without any risk because it's backed by cash. Now, with really high redemption rates, what's important is for the target and the sponsor provide as much information on their company as possible in a timely manner. Like Ashar said, disclosures are very important at the right time, but more than anything, it's about being conservative in your projections. What is really driving down, the end cash is we've seen really high projection growth rates, which are really driving the market down because these companies are getting battered by the macroeconomic environment and the geopolitical situation that we have currently. It's really impacting these companies. So as long as you keep your projections on a conservative level, you provide all the information and you are a market ready company. Mind you, it's a key term is market ready, having positive cash flow, very stable in the way you go, still having a growth story behind. That's what will help you have end cash in. But now what's really required are pipes. That's the demand at the moment because the redemption rates are still high. It's super lucrative for SPAC investors to just take the yield without any of the risk. So they're opting to take that yield and redeem their shares at the end. And what could really help the target actually get a lot of cash, which they need in the first place, is to go for pipe, which is a altogether different market and question.
Thank you very much, Samara. Khaled, do you think there's anything creative in your view that target companies can do to increase their chances of that cash and closing element? Because it is a very, very important incentive for target companies to have that cash element at the end. And is there anything that they can do creatively to increase the chances of that cash and closing element?
I think it really depends on the deal. I mean, we've seen over the years some companies that are really worth buying, that they put a lot of caveats inside the LOI and they put a lot of commitment, and even some of them ask private equity firms to put up money in an escrow account as maybe 10-20% of the transaction, and they put a condition that unless you find out in the due diligence one of these 1, 2, 3, 4 major deal breakers or whatever, you are to execute the transaction. If you do not, okay, the escrow agent actually transfers the money to the target company as a penalty. I mean, we've seen these kind of transactions. Some ask for proof of funds, and then some ask for money deposited in an escrow account. Some also put together the sort of the transaction expenses inside the LOI to make sure that the private equity firm is not just getting in to do some due diligence or what have you and just compare it and get out. Especially when you have competing businesses. So the target companies, they need to be very wary, because usually when you sign with a SPAC or a private equity firm, you sign basically exclusivity. So during the whole deal from the LOI until closing, this target company cannot even, I wouldn't even say accept another offer, but cannot even entertain another bidding process. And most companies would not go for, the right companies would not go for this kind of exclusivities. But if the price is right and the terms are right, they would do that. And most private equity firms, again, most of the sponsors come with the same mentality of SPACs. they would tend to go for exclusivity because you're putting up a lot of cost, you're putting up a lot of time in the transactions. So you don't want to go in and at the very end, you get into a bidding war. So the targets, one should actually evaluate the sponsors very well. Make sure that they have the funds at the time of the closing, because they can easily check out the redemption rate. It's easier than selling to a private equity firm. Okay, and at the same time have a sort of an escrow agreement in place with, you know, with excluding the major deal breakers to make sure that, you know, the deal, that it's a serious buyer and the deal will go through. Also for SPACs, I think to counter this, you know, a lot of SPACs have been trying to raise money through preferred equity convertibles, and they also try to put some sort of backstop agreements inside their new conditions for the redemptions and so on. So it's a two-way process, but it depends. If I'm on the target company side, I'm not going to entertain any offers. I'm going to lock down for like 9 to 12 months. Then I definitely would want money in an escrow account to actually pay off transaction expenses and the exclusivity period.
Khaled, you mentioned backstops, and so forward purchase and backstops, I think, are extremely rare in today's market. So what would it take, or what would have to happen for these processes and structures to come back into play? Ashar, would you be able to comment on that? Khaled, please. What would it take for the forward purchases and backstops to come back into play in these types of transactions?
Well, I think if you want the SPACs to work out, the key here is the redemptions. I mean, you cannot go in and just raise all this amount of money, again, compared to a private equity fund, because that's how it got evolved into the first place. Okay, so these backstop agreements and these sort of redemption, cornering redemption somehow, or making the threshold for redemption much higher and so on. By the way, the same happens with private equity firms. That's when they started, they had these low redemption thresholds, and hedge funds. I mean, we can learn from the hedge fund industry. In the beginning, you know, they started treating the funds as open-ended funds. And then after that, you know, when they found a lot of redemptions, they realized they cannot take positions and hold them for long and give it the entire life cycle of the investment. So they started to, you know, have some sort of threshold for investment in terms of timing, in terms of percentages and so on. So the SPACs have to get into that, because with the redemption ratios, one, with the current risk of redemption that we're seeing about like what 60 to 70% redemption ratios right now, the whole transaction will fail. Companies will not have access to fresh cash, to cash that is being used for growth and promotion. And then you will end up having the SPAC as a cashless entity just used to bypass the IPO process into, you know, for a reverse merger into an IPO. And that would not facilitate or entice the flow of capital into new companies. It would not entice the M&A activity or the economic activity. So I think I'm completely against the whole redemption. I'm completely against the whole, if you put money in a company, you put money in a SPAC for an acquisition. An acquisition has to have, you know, any company that's worth buying, okay, you will have to have some founders who are selling the company, so you have to pay cash. And any company that's worth investing in might need some capital for growth. So it's growth capital as well. It's not only buyout capital. So the SPACs should have the money to invest and to buy out companies, like buyout funds, rather than just to merge into a reverse IPO.
Redemptions absolutely key. I think in March this year, redemptions were averaging around 85% last month, but 78%, which is evidence that I think things may be getting better. Samar, would you agree? Are things getting better?
Yes and no at the same time. The reason we see lower redemptions is because of quality targets. We've seen the highest redemptions coming in because of the type of targets that were taken public. I wouldn't say that they are not great targets. We did have amazing targets that went forth via SPAC. They're public now, trading way above their initial $10 listing price. and doing well. But the question here is what drives down the redemption rate, and where do you see low redemption? Happens when you have a quality target, right? And also how sponsors, well, serial sponsors more than first-time sponsor, you will see them having anchor investors who are committed, having non-redemption clauses in the shares and the units that they take up, is because they trust the sponsor. So it's dependent on both the target and the sponsor in this case. If you have the right sponsor, they have the right institutional or financial backing, people who trust them. They will enter as anchor investors, taking up anywhere from 20% to 30-35% of the total IPO size, with no redemptions at all, because they signed on, they believe in the sponsor. So you need to have a balance between having the right sponsor and also choosing the right target company. If you find a good company which is market ready, cash flow positive, has the right elements for being a publicly listed company, and has a great growth story behind it, as long as their projections are conservative and also predictable, you will see the right backing. They will get the right amount of cash. They will get pipe investment coming from anywhere from private equity, hedge funds, low redemption rates. People have now started to do, as Khalid rightly mentioned, we're seeing more convertibles come into place where they put in conditions that if milestones are met, this is how we will convert. This is how you would get more money once you achieve particular milestones. So these are ways to also ensure that the market performance post the DSPAC is good. They do not really batter the company down in public markets, especially given the current economic environment.
Samara, thank you. Khalid, please.
I agree with you about the quality of the target, that you know, if you've got the right quality, theoretically speaking, the investors should stick and not redeem. But the problem is, pragmatically speaking, is the minute you have a redemption option, you start categorizing this investment as short-term in your portfolio because it's redeemable, it's callable at any point of time. So what happens is, if there is a rebalancing of the portfolio, if there is a reallocation, if there are any inverse market conditions, or if there is a, let's say, a deleveraging or a margin call on your portfolio, whatever, usually asset managers, okay, and the traders in particular, jump into redemptions because it's the most easiest money. It's just a call rather than selling it. So what happens here is that because of this, we get faced with a tenor mismatch in SPACs. So what you're trying to do long-term investments with short-term funding, and you have no clue and no idea when this money can be called in. And that kills the whole purpose of the SPAC, because at the end of the day, if I am investing in a company, not taking a small position, if I'm investing in a whole, I'm buying out a company, so I'm not actually looking to trade it. So usually redemptions in open-ended funds are being calculated all the time with regards to the positions you take and the liquidation ratio to the redemption. So that makes the open-ended funds usually very liquid. They understand the maturities, they understand the redemption, they do their calculations. But with the SPAC, if you take the money of the SPAC, invest it in, trading, the money gets called back in because it defeats the purpose. Same as the whole prospectus. But in this case, you've got money that is committed for long-term funding, okay, to a company, buying out the entire company, and that is financed by volatile funding, okay, that can just be drawn at any point of time. So I think, funny and ironically enough, the kings of capital who came up with the SPACs are the ones that here have a hole in their capital structure with a tenor mismatch. That's what we're seeing right now.
Thanks, Khalid. Ashar, please.
Brandon, thank you. Just a couple of minutes. Now, Khalid, what you've mentioned is absolutely right. And I always tell this to everyone, that everything in our industry or even in life generally is very simple, whether that's religion or investments. You have to boil down to the basics. asset liability mismanagement is basically clear divergence between your goals and your actions. We have seen Silicon Valley Bank collapse recently, which was basically the prime reason was a mismatch between the liabilities and the assets. Again, for the investors as well, as long as there is a good quality target, as Sumer said, cash flow generation is key. If you have that, you need to basically go ahead with that. But again, if you have a mismatch between your investors, investment horizon and the investment horizon of the asset class, you're always going to be in troubles with in terms of redemptions. You take any asset class, you'll face the same issues everywhere.
And I'm just conscious on time, guys, so I want to finish with this question before we open up the floor to questions. Khalid, where do you see the future of SPACs? How does that look in your view?
I think SPACs are going to play a major role in the region because of it facilitates really flow of capital. It makes private investments liquid. And we in the region have a lot of potential for private equity. I'm talking about Africa. I'm talking about Egypt in particular. There is depth. There are a lot of private equity companies, and most of the retail investors don't have access to these private equity firms. Now, if you come up with you fine tune the sort of the legal conditions of the SPAC, whereby you can have a blank check to invest in multiple companies without any sort of redemption, and to replace that redemption with actually opening the trading on the units. I mean, if you as an investor want to exit, you can always sell the unit in the open market. I think that, but you can stick to the 2 or 3 years investment commitment period and the lifetime of the SPAC and everything else. But you open two things: you shut down redemptions, you replace them with trading the unit day one. Okay, and the second thing is you actually open up the SPACs for multiple acquisitions rather than just demergers and just making it to bypass the IPO process. I think there will be huge potential for it.
I agree with you completely, Khalid. Ashar, the same question for you. Where do you see the future of SPACs?
I think Khalid pretty much summed it up, but again, yes, as with any new asset class or any new product, it goes through its cycles of improvements, of corrections, regulation. This has happened with every asset class. And again, with SPACs, it's going to be the same thing. Now, since we are in this region, for this region, I would be more specific. It's probably a little bit of aspect of Sharia compliance, and also the investor appetite in here. Now, the investor base in, because I'm originally based in Saudi, the investors in there generally have more control-centric kind of a behavior. So that sometimes might not go well with this kind of an asset class. But again, there's a growing middle class, a growing young population, which has this appetite for this kind of product. And if it is introduced rightly, I think it can do wonders. Adds liquidity to a lot of stuck-up portfolios in the region, and that would absolutely improve the flow of capital within the economy and also inside and outside the economy. So I guess the future is bright. Definitely, yes.
Future is bright. And Samar, you'll be glad to hear that, because you are a big promoter of SPACs, and you and I have had conversations in the past. Please give us your thoughts on the future of SPACs, where they're going and what's going to happen next.
Yes, sure. I think for the future, we will see, especially in the short term, we will see a smaller market size, decrease in competition for deals as the amount of liquidations of SPACs continue. We will see a decrease in competition for deals. We'll see fewer sponsors and likely higher quality sponsors, which is a great sign. We'll see stronger companies coming to market. Given the increased regulatory and investor scrutiny, we will see much stronger and public-ready companies coming to the market, but we still expect difficulties in raising capital from traditional areas such as venture capital or from the private markets. Reason being, fears in the market are just too many. What drive SPACs was FOMO, and now people do not want to enter this asset class that quickly because of the market conditions, really. But where we see it being easier to raise capital and me being part of a capital raising platform, and having worked with a multitude of SPACs, I know how you can really raise capital if you have the right parties on both ends. If you have the right sponsor and you have the right target willing to work together for long-term growth, I think it's not as difficult to raise capital, but still it will remain quite difficult to be raising capital.
I agree. And just to add to that, having the right advisor is also important. So
That's
with
the
that, I'd like to
advisor,
open up the
right?
floor. Sorry, Samar. Say that again.
I'm saying it's the advisor's role to make sure that everybody's aligned.
Exactly.
An advisor plays a great role. We work on advisory mandates for SPACs and for targets. We understand how, because we operate within the business itself, we have the experience, and it's experience which really helps, and the advice from a great advisor, which will lead to a successful execution of a transaction in SPACs. Critical.
100%. And we've seen it time and time again. So with that, I'd like to open up the floor to any questions. If anybody has any questions, please raise your hand. Anybody? No questions. Good. We must have done a great job. With that, so look, guys, thank you all again for being here. Thank you to the panelists. Thank you very much for all your insights. We look forward to seeing everybody this evening at the gala dinner. Thanks again to Joe, Dr. Fadi, and all the staff here. It's an amazing event, the production, everything, the quality of the speakers has been fantastic. We're honored and we're grateful to be here. Thank you all again so much for listening to us, and I hope to catch up with you this evening at the dinner. Thank you.
And thanks to you, Brandon Goodwin, the Vice President of Middle East at ARC Group, who was the moderator of this final panel discussion of this day, navigating a challenged pipe market and alternative de-SPAC financing structures. And a big thank you to the panelists as well. Khalid Rashid, the Managing Director at Misr for Central Clearing, Registry and Depository. Ashar Salim, Fund Manager at Yaqeen Capital. And last but not least, Samar Chopra, who joined us virtually and is the Director and Founding Member at Illumia. Ladies and gentlemen, that concludes day one of the conference. We look forward to seeing you all tomorrow morning at 9 a.m. sharp, where we will resume the conference by starting panel 6. Thank you all and see you in the morning. Have a great evening.